on chapter number 15. And as you can remember, I showed you in my last lecture, if you saw that video, this is a typical balance sheet for any company. So of course, there are assets and there are liabilities. So if I'm talking about weighted average cost of capital, we are concerned about the liability side. And on the liability side, as you can see, there is like account receivable, there are some other accruals, and there are notes payable, long-term debt, preferred stock, although it's zero here, but typically preferred stock, I mean, companies, they do have some preferred stock on their balance sheet, common stock and retained earnings. So not every liability actually qualifies for investor supplied capital. So as the name suggests, it is that part of the capital which the investor provides to the company for a return. So for example, accounts payable, it's not a credit which normally is extended for a return. It's like a trade credit. So they provide, let's say somebody is providing you a raw material on credit. So of course you have to pay only the principal amount. You do not pay any interest on top of that. So the only things that qualify for interest-bearing, let's say, debt, it's notes payable, which is right here, and then of course the long-term debt, normally bonds, and then preferred stock, although it's zero here, but as I said, most of the companies, they carry some sort of preferred stock on their balance sheet. And then they have common stock, and then you have retained earnings as well. So, for example, let's say I showed you this in my last lecture as well. So, for example, a company is carrying $35 billion in long-term debt, $15 million in preferred stock, and then common stock equity is 50. So, in total, the long-term financing, or let's say what I can call the investor supplied capital for this particular company is $100 million. And if you convert it into weightage, which is mean like percentages, of course, very easy to calculate. 35 divided by 100 is 35%. Now, if you remember in my last lecture, and if you saw that video, we covered the cost of debt. So in my last lecture, I taught you how to calculate the cost of debt. Now, in today's lecture, we will cover how to calculate the cost of preferred stock and how to calculate the common stock equity, the cost of common stock equity. If you remember from chapter number 4, which was valuation of long-term securities, we are using exactly the same concept. Like I would say 95% of the stuff that we'll be covering today is exactly the same that we covered in chapter number 4. So if you remember for preferred stock, that cost is called KP. We represented it by KP, and the cost of common stock equity was KE. So cost of preferred stock. So preferred stock, if you remember, it's like a hybrid security. It has some features of common stock and it has some features of bonds or any fixed income security. So the features of fixed income security, for example, it carries a fixed interest rate. So cost of preferred stock is the required rate of return on investment of the preferred shareholders of the company. So if you remember from chapter number 4, how did we put a price on preferred stock? It was P0 equal to DP, which is dividend of the preferred stock, divided by KP. And why this formula? Because it is like perpetuity. Okay, so if I put it on timeline, 0, 1, 2, 3, and let's say infinity. Preferred stock does not have a specific maturity, so they go forever. And for example, at the end of each year, you are getting DP. So if the
Assalamualaikum, sir.
Walaikum Salam. Any question? Okay, so I'll take that as a no. Okay, so this is a typical timeline for a preferred stock. So as I said, preferred stock does not have a maturity. It goes forever. So for example, let's say each year, if a preferred stock is paying DP as the return, okay, so the way we calculate price of that security is DP divided by KP because it's a perpetuity. And if you remember, we derived this formula from the geometric series. From geometric series, or sorry, from something. I don't remember now. Anyways, so if you remember from chapter number 4, the price of preferred stock, we calculated it in this way. So it's a simple algebra. So the way we calculate now, the cost of preferred stock is dividend divided by price of the current market price of the preferred stock. Example, so this is a very, very simple example. So for example, Basket Wonders has preferred stock outstanding with par value of $100. Okay, so this is the par value. Dividend per share of 6.3 and the current market price of 70. Now, this information is, we do not need it. Don't need this information. Because what we need for KP, if you remember from my previous slide, KP is equal to DP divided by P naught. And P naught is actually the current market price. So I'm not concerned about the face value. I'm concerned only about the market value of this security. So KP is equal to DP, which is dividend 6.30 divided by the market price is 70. So whenever you have this question, let's say on exam paper or anything, please do not use this number. So you have to use the market price of preferred stock. So as a result, we get the cost of preferred equity as 9%. Now, this is a simple example where all the information that we need to calculate the cost of preferred stock is given. This is a little bit complicated. Little bit, I would say, like not even medium. It's like an easy question. So a company sells 10% preferred stock issue and $50 is par value at the current market price of $49. What is the cost of the preferred stock? So how do I calculate DP? I multiply 10% with 50 because dividend is calculated on the face value. So you get $5 as a dividend and the current market price is 49. So 4 divided by 49 is equal to 10.20. So sometimes the information are not explicitly given. So you have to calculate one of these, one of DP or P naught, and then you can apply the formula and get your answer. Now, preferred stock, calculating cost of preferred stock was not that difficult. Cost of equity, which is like common stock, it's little bit more demanding and compared to this cost of debt or cost of preferred stock. We will use the same 3 approaches, 3 assumptions. So these were the 3 assumptions that these 2. So we already covered that in chapter number 4. So in chapter number 4, we had no growth assumption. And then we had constant growth assumption. And then we have growth in phases. And I'll show you. So the dividend discount model, the first one that we covered. So We covered that in chapter number 4. The capital asset pricing model, if you remember, was chapter number 5. So we will use the same techniques that we already learned. The third one is a little bit different, but again, it's very easy. So dividend discount model is this. So what you do, you discount all dividends, and then you get market price of that particular security. So let's say if I put it on the timeline, how does it look like? So at zero, I have D0 as a dividend, D1, D2, D3, and then let's say D infinity. So this is, let's say, infinity, and we have D infinity. So what I need to do, I have to discount all the dividends. But now the problem is, how do you forecast these dividends? Because 0 means today. For preferred stock, I can tell that it's fixed. The income associated with that particular stock is fixed. So yes, we can forecast that. But for common stock, dividend is not fixed. It can be $1 per share. It can be 50 cents per share. It may be $3 per share. And it may be even 0. Let's say if the company makes losses, or let's say if they do not declare any dividends, of course you get 0 for that. So it's a very, very difficult security actually to price it correctly. So we have to work with some assumptions. And the first assumption, as you remember from chapter number 4, is constant growth. So the constant growth assumes that, let's say, if I put it again on the timeline, 0, 1, 2, this is infinity. So let's say if dividend here is D0, D1, D2, and here it's D infinity. Now the assumption is that the dividend grows by a rate of G. So the growth rate is G. So for example, if dividend here is D0, here it is D0 into 1 plus G. Okay, and in year number 2, it's D0 into 1 plus G squared, because dividend here grows by G, and then again it grows by here by G. So within the years, the growth is G. So the formula that we derived in chapter number 4, if you remember, was P0 equal to D1 divided by KE minus G. So you can easily now calculate this KE, and this is the way you calculate KE. So the first assumption is constant growth. Example, again, Basket Funders had a common stock outstanding with a current market value of 64 per share, current dividend of 3 per share, and the growth rate of 8% forever. So in order to calculate KE, we use that formula, and for D1, we use D0 into 1 plus G. So again, do not make this mistake. The current dividend, so the current dividend is 3. And if you are, let's say, evaluating this security, it means that the $3, somebody else has already taken it. Somebody else already took that dividend. Right? So let's say, if I tell you that, okay, the current dividend for PTCL share, or let's say OGDCL share, is, let's say, 10 rupees per share. It means that the 10 rupees, the existing shareholders already took that money. So let's say if you are interested to buy, or let's say evaluate PTCL, of course, $3 is not relevant to you. To you, the relevant number is D1, something that you will be getting in the next year. So please always make that adjustment. Do not forget that. I cannot emphasize more on this one. So D1 is, of course, G0 multiplied by 1 plus G divided by P0 plus G. So 3 multiplied by 1.08. So as a result, we get actually our cost of equity is 13%. Any questions so far, Harris?
No, sir.
Okay, perfect. Any other students who would like to ask me any question? Please raise your hands. Okay, so I do not see any hands here. All right. So how do I go back to my previous? Okay, so let me stop sharing and then I'll share again. Anyways, can you see my screen now, Haris?
Yes, sir, I can.
Perfect. Okay. Okay. Growth phases model. Now, as I told you while I was covering chapter number 4, this one looks messy, but this one, if you closely look at it, it's not that what's this called? It's not something that does not have any explanation or any logic for it. So, for example, let me put it numbers on the timeline, and then I can tell you how did we come up with this formula. So suppose there is a common stock and there are 3 growth phases. And normally we work with 3 growth phases. The reason is, let's say if a company is new and they are in the growth stage, they have a different, their product, or let's say their company has a different life cycle. Then it comes to maturity, and then sometimes because of the competition and because of the age, it starts going down. So what we do, we start working actually normally with 3 growth phases. So suppose for 5, 6, and let's say 7, and then up to infinity. Okay, so assume, let's say, in the first 3 years we have growth G1, and then in the next 3 years we have growth, let's say, G2, and then in the last phase we have growth G3. So what I'm really interested in is actually discount all the dividends for the first phase with G1, and then discount all the dividends with growth G2, and then for the last phase, of course, we have to use that perpetuity formula. And I have given you, I think, 2 different examples. I solved one question during my lecture in while covering chapter number 4, and then in the extra sessions we also did some exercises for growth in different phases. So please go back, have a look at those questions. They are super easy. They're super simple. There's no technical. There's nothing technical about these problems. Now, capital asset pricing model. We covered this in chapter number 5, risk and return. So the cost of equity capital, KE, is equated to the required rate of the market in market equilibrium. The risk return relationship is described by the security market line. So in capital asset pricing model, we are actually dealing with excess returns. So suppose the risk-free rate, so this is government rate. So let's say if the risk-free rate is 4%, of course, in order to invest in a company, you need more than 4%. So in a way, you are interested in excess return. Okay, so capital asset pricing model. So if you see here, if I transfer this RF here, so KE minus RF equal to the market return minus RF into beta. Okay, so this beta actually it's a sensitivity of the individual stock price with the market. So here it's the excess return of individual stock, and it can be actually a portfolio as well. And this is excess return or the market, because this RM, this return, this is average return of the market. If I show you actually in a graph, a beta of equal to 1 means that, let's say, if the market gains 10%, the individual stock or your portfolio also gains 10%. This angle is 45 degrees. Okay, so let's say if the excess return on a market portfolio is 10%, the excess return on the stock as a result is also 10%. So because the angle is the beta is 1, so the relationship between excess returns of the individual stock and the excess returns or the market, it goes 1 and 1, so 10% and 10%. But let's say, what if the beta is less than 1? It is called also defensive, or let's say if you are working with a portfolio, it's the systematic risk in those portfolio or individual stock is less. So let's say there may be a big jump in the market. So for example, let's say there is 20% change here in the market return. But if you see the resultant change in their portfolio may be 10%. So this is a defensive. So anything less than 1, it's a defensive beta. So let's say if you are an investor and you would like to either balance your portfolio, or let's say if you do not want to take excessive risk, or in other words, you are risk averse compared to other investors, you will go with those portfolio whose beta is less than 1. So the market gains more, you gain less. But if you see the flip side, if market loses, let's say 20% here, your benefit of defensive portfolio is that you also lose 10%, not 20%. So it's a defensive portfolio. On the other hand, let's say if the beta of your portfolio or let's say individual stock is more than 1, it's aggressive. So small changes in the market results in bigger changes in individual stock. Example here, let's say 10% again. It looks like 20%. So let's say if beta is greater than 1, of course, 10% will translate into 20% only if this beta was 2. It doubles, okay? So you make more money, let's say, if the market is moving in the right direction. But what if, let's say, if the market does not move in the right direction? In fact, let's say if the market contracts, if the market loses, right? So, for example, let's say market loses 10% here, minus 10%, okay? And if you see your losses are close to 20%. So if beta is 1, it means that your individual stock or your portfolio is moving with the market, 1-to-1. If beta is less than 1, it's a defensive strategy. If beta is more than 1, it's aggressive strategy. Now, this is security market line. So what you could do actually for all individual betas. So for example, we have, let's say, OGDCL stock, we have, let's say, PTCL stock, or let's say Pakistan Tobacco Company, okay, and many more, okay? Now, each company has its own beta. So if you plot all the betas against the excess returns, you get a line, and it's called the security market line. This one is RF. RF is a risk-free rate. So no matter what, you get that trade. So that's why the line starts from here. The line starts from here. So no matter what, you can easily invest your money in a risk-free rate and get RF as a return. So the minimum that you expect as a premium is this one. So for example, let's say, if the beta of a certain stock is 1, this is the minimum excess return that you expect here. And let's say if the beta is, let's say, 0.5. Okay, so I'll go here. And so then this is the minimum return that I'm expecting. And as you can see, beta is a measure of risk. Okay. So if the risk goes down, of course, your premium also goes down. So let me write it for you. If risk goes down, premium goes down. And vice versa. If risk goes up, premium goes up as well. Here, let's say if the beta is 1.5, and if I see here, so as a result, your risk premium is this much. Okay, any questions so far? It's a very important topic, so if you have any questions, please do not hesitate to ask me.
Sir, I have a question.
All right, and what's your question?
Sir, which beta is more riskier, like negative 2.0 or 1.2?
Sorry, say it again.
Which beta is more riskier, the one with negative 2.0 or the one with 1.2, positive 1.2?
So if you see the excess return, let's say for any stock is, let me go back. Okay, so the risk-free rate here, this is the excess return for individual stock. And you think that, okay, what if, let's say this beta is negative? Okay, so if this beta is negative, the whole return for this side will also be negative. So it means that the market is contracting.
No, sir, I have a general question. Like
Yes, sir.
if there's a stock with beta of minus 2.0 and then there's a stock with a beta of 1.2. So which one would be riskier here?
No,
Yes,
so here actually, here it goes against the market. So let's say if the market is going in the upward direction, your portfolio is actually contracting. So you wouldn't go for any portfolio which has a negative beta. The reason is one of the tasks is actually to move with the market. That's a very defensive strategy. It's like beta of equal to 1. But let's say if your beta is negative, it means that if the market is gaining, you're losing. So you wouldn't come up with a portfolio which has a negative beta. But let's say theoretically, if there is a negative beta, of course, if the market goes upward, you are losing money. But let's say if the beta is 1.25, it's a little bit risky. The reason is if the market is making money, you also make money. But if you comparatively you make more money. But let's say if the market is going down, your losses are also multiplied by 1.25. You're also making, your losses are actually enlarged with the beta. So I would say this one is more risky, the negative one, because you are not moving with the market at all. You are moving in the opposite direction. Did I answer your question?
Yes, sir, got it. I was thinking the same.
Okay, you're welcome.
My pleasure.
Now, determination of the cost of equity, CAPM, okay? Again, all the numbers are given. So assume that Basket Wonder has a company beta of 1.25. And by the way, Reuters, they calculate company betas. So this is not something like there is no rocket science into it. Yes, there are sophisticated models behind those calculations, but you have access to those information. That's the whole point. So Julie Miller suggests that the risk-free rate is 4% and the expected return on the market is 11.2%. So KE of this stock is 4% plus 11.2 minus 4 and multiplied by this beta is 13%. So as you can see, the market return was only 11.2%, but the single portfolio, single stock return is 13%. So actually, we are outperforming the market. Okay, so the market is, let's say, market portfolio is getting you 11.2%, but this particular stock is making you 13%. But again, the downside is, let's say, what if the market moves in downward direction? Let's say, what if the market loses? Of course, your losses will also be enlarged because of that beta. Okay, so there is another approach, and we are using this approach for the first time. It's called before tax cost of debt plus risk premium. So as the name suggests, the cost of equity is of a certain company. So for example, let's say OGDCL. So the cost of equity of OGDCL is the cost of their debt plus a risk premium. Now, why do we add risk premium to the cost of debt? I'll give you an example. So suppose we are talking about OGDCL. CL. Okay. If I'm talking about debt and there is common stock. Okay. Debt, it has fixed income. So no matter what, whether OGDCL makes money or if they do not make money, the debt holders, the bond holders, they will get their return no matter what. Okay. Let's say if the company liquidates, they default, so they take priority over common stockholders. Okay, so they will be given their money first. On the other hand, common stock, one of the major source of return is dividends. They are uncertain. Okay, and of course, their claim is residual. They're called residual claim. So let's say if the company goes bad, whatever is left after paying the debt holders and the preferred stockholders, they get the residual money. Okay, so on face, if you can see here, risk is high. On common stock, risk is high. But of course, if risk is high, the return is also high. So it goes both ways. So risk of common stock compared to debt holders, it's high. So let's say if the cost of debt for that particular company is 8%, of course, you need a premium to buy their stock. Okay, and I hope you see the link here. Since common stock is high in risk, they need a premium or the cost of debt. So for example, if the OGDCL, if their cost of debt is 8%, that is something for cost for debt, but in order to buy their common stock, they need a high return. And if I show you on the next slide here, we can calculate actually beta for debt instruments as well, and for equity as well. So this is security market line. of course, it starts with the risk-free rate. Okay, so this is what you get, like risk-free. You do not take any risk here. You do not take any risk. It's like investing in government security. Okay. This beta E, which is like for common stock, and it is sensitivity to the market. Your required return is KE. But as I said, here you also need premium for lending to, let's say, OGDCL. And why do you need premium? Let's say if you do not get any premium, let's say no premium, for debt. So my other question would be, why would somebody lend, or let's say buy a bond? Lending money or buying bond is exactly the same thing. To OGDCL, of course, this one is a risky company. Okay, so why would somebody take a risk and make no money? Because risk-free, they're already getting a risk-free rate with government securities. So why would somebody lend money to OGDCL for no premium? Of course, they need a premium. So this is, for example, let's say this is the premium that they need for what's this called? For lending to OGDCL or any other company. And as I established in my previous slide, that the company also needs premium for investing in the equity, in their equity. And why do they need premium? Because this one is more risky. Reason, common stock dividend is uncertain. And number two, they have a residual claim on company's assets. Okay, so in this slide, talking about this risk premium, it's not actually premium or the market. This one is not premium or the market. This one is premium or the cost of debt. Premium or cost of debt. So I hope you can see. Okay, in the book, this method is called quick and dirty method. So this is not a very scientific method, but of course, if you are investing money in certain company assets, I mean common stock, the cost of equity provides you a benchmark. So of course, the company is also trading their, let's say, bonds on the market, and let's say if the bond says that okay, minimum, the bond is paying 14% on common stock, you need a premium, and premium, let's say 3% premium, and as a result, your required rate of return on equity would be 17%. You wouldn't be happy with this 14%. Okay. Again, example from basket funders. So they typically add 3% premium to before tax cost of debt. And this one is very, very important. So it is before tax cost of debt. As let's say, if you've seen my last recorded lecture, we calculate cost of debt. Let's say if it's 8%, and let's say if the marginal tax rate is 40%, then KI, which is like the after tax cost of debt, is 8% into 1 minus 0.4. So in this case, it's 4.8. So you have to work with before tax cost of debt, not the after. So in my last lecture, I covered that you have to calculate KI, like the after tax for cost of debt. But in order to calculate actually the cost of equity using this cost of equity plus premium approach, we have to take the before tax. So do not confuse it with the cost of debt. In cost of debt, we are using after tax. In this approach, we are using before tax. So you have to keep that in mind. And once you plug the numbers, I mean, it's very easy. And this is my bad. This one is actually 3%. So that's why its KE is 13%. Okay, so if you remember, the constant growth model that I calculated, the cost of equity was 13%. Capital asset pricing model, 13%. Cost of debt plus premium is 13%. Now this is coincidence that we chose the numbers so that everything results in 13%, 13%. Generally, all these three methods, they will not agree. But of course, if you calculate cost of equity using all three approaches, at least you know what approach is resulting in what kind of returns. I will stop here, and then in the next lectures, we will use all these three individual approaches. Like, for example, we will use cost of debt, and then you will use cost of preferred stock, and then we will use cost of common stock to calculate weighted average cost of capital. So since we have learned how to calculate like cost per individual, I mean debt, preferred stock, and common stock. Now the only task remaining is plug those numbers, use different approaches, and calculate weighted average cost of capital, or in this book it's called overall cost of capital. It's the same thing. Any questions? Please send me an email or WhatsApp group. I will stop here, and if you have any questions, you can ask me now, or maybe you can send me an email. It's up to you.
Attendance mark okay?
I will mark attendance right now. Yes, it's done now.
This is the main question, sir. Thank you so much.
You're very welcome. Acha, एक चीज I would like to clarify. Number one, two things actually, two things. पहले मैं मतलब वो बताता हूँ. एक तो ये है कि deadline, ठीक है? Deadline is quickly approaching for assignment, ठीक है? Assignment, अगर आप मेरा NPV IRR वाला मतलब recorded lecture देखते हैं, ठीक है? I recommend को उसको आप देख लें, ठीक है? क्योंकि वो आपको help करेगा. But let's say, even if you do not watch it, that assignment should not take you more than 2 hours, provided अगर आपने किताब पढ़ी है, ठीक है, और वो lecture देखा हो, ठीक है? So please try to hand that assignment within time. I will not accept any late submissions, ठीक है? Some students by mistake, for example, they uploaded assignments into the project. Some students actually uploaded assignments a little bit early, and they thought that they should work a little bit more on that one. So yes, that's fine. They have already sent me their revised assignments through email. But after 12 tonight, I will not accept any late submissions. I think it's not fair to your other classmates, because most of you are working really hard and handing in your assignments on time. So no late assignments this time. Number two, this is our last lecture before Eid, so I wish you all the best for your Eid. सबको ईद मुबारक, आपके parents को, आपके family members को, और आपको, ठीक है? And as usual, inshallah, you're very welcome. Inshallah, as usual, next week, Thursday, क्योंकि छुट्टियां technically Wednesday तक है, ठीक है? So Thursday, we will have our online session. So the way it will work,
Excuse me, sir.
Thursday will be live session, just like today.
Sir?
Yes, sir.
Can we not have it on Thursday, please? I don't think I'll be available then. 8080,
let me see, who is this? I'm sorry, I cannot recognize.
I said.
Dubai.
Asad?
Dubai.
Asad, okay. Asad, so you do not have any access to internet, let's say on Thursday?
Yeah, kind of. To an
So
extent.
you're going to Dubai and you're telling me you do not have any access to internet there?
No, I'm not going to Dubai for Eid, sir.
So what will change on Thursday?
The thing is,
So what is it?
I'm going to Swat for Eid, right? And I'll be back in Islamabad by next week, like the weekend.
Okay, not a problem. I mean, if it's a general
सर
problem,
काफी लोगों का ये इशू है सर, तो काइंडली प्लीज आप थोड़ा सा
that's fine. That's fine, Asad. If you could, let's say from Sawat, let's say if there are no connectivity issues, it's a 1 hour session. The thing is, like for example, for recorded lectures, if you watch that, I mean, I highly recommend that you watch it right away. The reason is, of course, every lecture builds. So my today's lecture was building on the last 2 lectures. So let's say if you miss it, I'm sure you will be clueless in my next lecture. So whenever I upload a lecture, I mean, it takes only like 30, 40 minutes. And I'm sure all of you have like that much time to watch those videos.
No, so what I'm saying is for next Thursday, can we have a recorded lecture, not an interactive session as such?
No, even like the interactive sessions, I record them and they actually show on the course timeline. So for example, today's lecture, I'm already recording it. So let's say even if you miss it, the live session, you can always go back and watch our live session recorded.
No, the whole issue of this being with my attendance, not the recorded or the interact live sessions. I have an issue with my attendance.
Okay, so let's not worry about it, Asad. Okay, the kind of situation that we are in. Okay. Well, let's say if it comes down to, let's say 1 or 2 attendances, 1 attendance max, I'll accommodate you for that.
Sir, excuse me.
Yes, Azam, go ahead.
Sir, can you repeat the deadline of assignment?
Say it again, Azam, please.
Sir, can you repeat the deadline of assignment?
that's Usman.
Oh,
It's,
here I'm Usman.
I think it's tonight.
Night 12 p.m. So
Okay.
confused.
Okay, so I'll stop the recording here. Please stay online. I'll stop the recording here, and then I can tell you from my CMS. Okay, so stay online.